The government gives you a 20% return, guaranteed. There's no better return in any government plan than that. They pay you to save. So you put in $2,500, let's say I put $2,500. The government kicks in $500. It's called a Canada Education Savings Grant. That's $3,000. If mommy and daddy had done that every year since you were born, multiply that by 18, you would now be sitting somewhere in the neighborhood of $54,000. That's before you invested. If mommy and daddy had invested that in a conservative little balanced mutual fund, a mutual ETF, or a balanced ETF, and grown that money, I would suggest they would grow that somewhere in the neighborhood of $80,000. And $80,000 will pay for 4 years of you to go to Western or Queens or Laurier or anywhere you want to go. When it comes time for mommy and daddy to write the tuition check, all they do is they fill out a form, they walk into the bank, and the bank writes them a check. So this is a check to Andrew for $8,000. So I withdrew some money out of his RESP. I took some money out of his RESP to pay for his tuition. In other words, I didn't have to borrow. I didn't have to sacrifice. I didn't have to skip the trip to the Bahamas over at Christmas. I didn't have to say to my kids, well, there'll be no Christmas gifts for you this year because I had to pay for education. So you have a choice when you become parents. You start paying for your kids the year they're born, or you're looking at $20 and $40 and $60 and $80,000 to finance them. You love your kids, but every one of them has a huge, huge cost attached to them. Huge. So, have to ask yourself this, and then I'll get to your question, Mr. Vasey. Do my parents have an RESP for me? Did they do this? Some of your parents will. Fantastic. Others do not. So again, if your mom and dad didn't do this, they just didn't know. Or they made other choices with their money or whatever. But my point is this. My kids don't worry about paying for school. For many of you who are coming up on 17, 18, paying for school is crossing your mind. And my kids don't. My kids don't simply because I made this a priority when they were 17, 18, and the government was paying me 20%. I'm like, I'm getting my 20%. Mr. Vasey.
Like when you withdraw the money, do you have to like somehow prove to the government that you used it?
Yes, I do. So what I have to do, it's quite easy. I get a letter from the university stating that Andrew was a full-time student at Guelph. He's in second year, blah, 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 and that's all. In other words, I don't have to send them my bill or anything. I just say he's a full-time student. They never ask for receipts for residence or anything, so I just pulled out $8,000 for him for Brendan, and I pulled out $20,000. I pulled out $30,000 over Christmas. Again, I'm not stressed about it because I've been saving for 18 years to do it. Okay, so anyway, this is just another example for you. It's too late for you, by the way. You can't open an RESP now. But it's just an example of things that are in place for you to do for your kids and some questions to ask about yourself. Again, if your parents have one of these, great. If your parents don't have one of these, your parents probably just aren't maybe as financially literate as you might think they are. And I don't mean that in a mean way to whatever. So like the reality is you've got to look for where you're getting your advice from. Okay, so RESP. Okay, many times we've talked about Core and Explorer. Looking at your portfolio and perhaps having as much as 3/4 just in brain-dead S&P 500 ETFs with a razor-thin MER, pay virtually nothing, buy the markets, couch potato, do nothing. Right? We've talked about that. We've also talked about that's a great way to avoid being in Canada. Don't invest all of your money in Canada. One of the most common investing mistakes we make as Canadians is to overemphasize us. Domestic is us, Canadian. Overemphasize domestic stocks and play down markets, U.S. internationally. If you've been ignoring advice to diversify outside the country, here's some incentive to change. At a time when so many assets are expensive, international stocks are now cheap. Recent column looked at some analysts by market managers, PWL Capital, on which assets were expensive, fairly valued, and cheap. PWL believes in building diversified portfolios that include all or most major asset classes, not in timing. So if you're building a portfolio today, you will need to include some assets that can be considered expensive. Fine. International markets. Those outside North America are where you get to buy at better prices. PWL analysis shows Europe and Pacific markets to be fairly valued, emerging markets cheap. You'll also want some US exposure, even though it's seen as kind of being expensive right now. US is a little expensive, but it can get way more expensive. Precise mix of Canadian, US, international stocks isn't particularly important as long as you don't shortchange any one region with just a token weighting. Investing 1/3 of your portfolio in each region is fine. And so having 20% in US and international markets. One argument for retaining a larger Canadian holding is you have non-registered stocks. How expensive are some of these markets? What are the returns like? Well, again, the Canadian stock market was a dog last year, up about 6%. We know the US market was up like 20. All right, let's talk about hot stuff. Core and Explore. Here we are, safe and conservative, our index stuff, global markets. Now we want to explore a little bit. Volume is important to understand. If you have a handle on volume, it often leads price. So there's a phrase, volume leads price. In other words, if you see all kinds of people, all kinds of institutional investors, pros, money managers, loading up on particular stocks, that may be an indication that they know something. So volume precedes that price motion. Look at the top stocks in Toronto by volume, and then look at their percentage change. These are the super white hot stocks that have everyone in a frenzy. This is the weed stuff, right? Weed, Canopy Growth. These are all, like, this all super. So, can you get into some of those things? Of course you can get into some of those things. A suggestion to you. You would be ill-advised to look at this table and say, hey, forget it, Mr. Masters. What I'm going to do is I'm going to make this my core. I'm going to load up on weed. And I'm going to load up 3/4 of my portfolio on Bitcoin, cryptocurrencies, weed, blockchain. Woo, let it ride. And the reason, of course, for a hesitation is this is a short-term trend. There is no way that 400% yearly gains are going to continue, and you may be buying an absolute peak. So we want to make sure we're conservative. Our core is in that steady ETF, super cheap, invest in the markets, and then if you want to go ahead and explore, fine. But I would add that you don't want to have anywhere more than 5% of your portfolio in anything like that. If you have 5% of your portfolio in that, it doubles, you go to 10, fantastic. If you have 5% of your portfolio goes to 0, okay, you lost 5%. An expensive mistake. Imagine having 75% of you in your portfolio in something super risky and getting cleaned out. I'll give you a simple little example to end with. About 15 years ago, the last bubble like this was occurring, and it was a dot-com bubble. It was an internet frenzy. Don't forget, I sent my first email here in 1999, so only about 2 decades ago. I know for you, you feel like the internet's around forever, of course, because of your age, but it's not. And so there was a dot-com frenzy. Honest to God, if it said .com, the shares like would quadruple in a day when it started trading. And so many teachers who were approaching retirement got talked into commuting their pension. And commuting your pension means this. Here's my pension. I leave it with the teacher pension plan, and they pay me every month till I die. Commuting it says, screw you guys, I want my money. And so pulling it out of the pension plan was legal and still is legal, and financial advisors talked teachers into it. Take the money up. And at that time, the hot .com stocks were going up like 30, 40% a month. And those teachers commuted their pension, invested it in .com stuff, and blew it all. And that's why we have supply teachers still here who are 15 years beyond their retirement, still supply teaching, because they blew their pension. And so I would say to you the following. It can be very tempting and exciting to hop onto weed or Bitcoin or blockchain. But that is the danger And believe me, it can happen if you buy at the top and it gets blown out of the water.